Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, January 23rd. To view our full range of trading services and publications, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. The evidence increasingly points to waning inflation and an eventual easing of the rate tightening cycle. Risk on is coming back into style. The year 2023 kicked off on a bullish note, fueled by reassuring inflation data in the U.S. and around the world. Central bankers in this country and in Europe are signaling that they might soon get less hawkish. That said, stock markets dipped last week as Wall Street's mood darkened again. A litany of woes emerged. The U.S. saw weaker manufacturing activity and retail spending. China posted anemic gross domestic product growth for 2022. The Chinese economy grew on a year-over-year basis by only 3% in 2022, the lowest annual reading since China started reporting GDP in the 1970s, excluding the pandemic slump of 2020. Meanwhile, Washington has descended into acrimony over the debt ceiling. A default would crater the financial markets, but some members of Congress are more interested in putting on a colorful show for the media than in actually solving problems. Fortunately, political risk tends to be short-lived. A resolution of the debt ceiling crisis is likely eventually. As for corporate earnings, they continue to come in mixed. For Q4 2022, with 11% of S&P 500 companies reporting actual results, the blended earnings decline for the S&P 500 is 4.6%. However, if the historical trend of companies beating expectations is factored in, we should see Q4 earnings season end in positive territory. The actual earnings growth rate has surpassed the projected earnings growth rate at the end of the quarter in 38 of the past 40 quarters for the S&P 500. Stocks paired the week's losses by soaring on Friday. On the last trading day of the week, the New York Stock Exchange Advanced Decline Line, the NYAD, notched a new high, and the tech-heavy Nasdaq posted the third straight week of wins. Take a look at the following chart. Year to date, the indices are in the green. Another sign of economic optimism is the rebound in crude oil prices, which gained 2.3% last week. Increases in demand and fears of supply disruptions have put upward pressure on oil prices. This year, I believe that concerns about inflation and interest rates will increasingly give way to a solid case for growth. Goldman Sachs expects the S&P 500 to end 2023 at between 4,200 and 4,300 points, up to 12% higher than its 2022 year-end level. And according to an analyst consensus tabulated by research firm FactSet, the bottom-up target price for the S&P 500 is 4,504.39, which is 13.3% above last Friday's closing price of 3,972.61. The consumer discretionary plus 22.6%, communication services plus 20.8%, and information technology plus 18.9% sectors are expected to see the largest price increases. These are considered growth-oriented, cyclical sectors. An increasing number of analysts are claiming that the Federal Reserve has won its war against inflation, and now it needs to stop hiking interest rates. The economy is slowing, which is actually good news because it squashes inflation. We're already seeing signs that jobs, wages, and home prices are slackening. Americans are increasingly optimistic about inflation cooling, and inflation expectations often become a self-fulfilling prophecy. Disinflationary pressures are building across the board, and yet the economy has been avoiding an outright recession so far. The elusive soft landing is a distinct possibility. The start of 2023 has been choppy, sure, and we probably face further volatility ahead. But remember this important rule. Liquidity drives the markets. Once the Fed pauses and stops siphoning off liquidity, stocks will surge. The table is getting set for a new bull market. We still face several risks, such as political gridlock in Washington and the Russia-Ukraine war. However, One day soon, these headwinds will dissipate, and that's when we'll see an explosion of new advancements in 5G wireless, genetic engineering, the cloud, green energy, electric vehicles, artificial intelligence, 3D printing, nanotechnology, space exploration, the Internet of Things, and more. High beta tech stocks are particularly sensitive to inflation and interest rates. When stocks eventually rally because of falling inflation and rates, tech stocks should outperform. All eyes are on the next Federal Open Market Committee FOMC meeting scheduled for January 31 to February 1. The Fed funds rate currently hovers at 4.1%. The expectation is that the FOMC will hike rates by another 0.50%. A steady decline in rates over the past 2 months have forged a consensus that rates are likely to level off through early 2023. Since 1980, in the 12 months after the final Fed rate hike, the S&P 500 was up on average about 15%. There is a strong argument for increasing your exposure to the stocks on your wish list, especially the brand name tech stars that had gotten too pricey. Now let's take a look at the week ahead. Keep an eye on these market-moving reports. Leading economic indicators Monday, S&P manufacturing and services PMIs on Tuesday, initial jobless claims and new home sales Thursday, and the PCE price index and consumer inflation expectations Friday. Well, that's it for now. Thanks for watching. And if you have any questions or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com.